What's up, everyone? So check this out. Raoul Pal, the ex-Goldman Sachs executive, just unleashed this absolutely mind-blowing thread on X. I'm talking about serious data, real analysis, the works. And I'm going to break down every single piece of it for you because what he's showing us here, it's the perfect roadmap for why crypto markets still have so much room to run. And yeah, XRP's golden era, that's ahead of us, not behind us. Look, I'm telling you right now, I genuinely believe XRP is going to deliver that legendary face-melting surge we've all been waiting for. That euphoric moment where everything just explodes upward. We've been patient for the better part of 10 years, right? So why on earth would it just not happen? That doesn't make any sense to me. Here's the thing about Raoul Pal. This guy opened my eyes to what the most crucial metric is when you're watching these massive macro trends unfold. And honestly, that metric is a major reason I'm sitting here with rock-solid confidence that this market cycle still has gas in the tank, way more than people think. Plus, he's got this fascinating explanation for why this particular cycle is playing out slower than the previous ones we've witnessed. What really stands out is how confident he is that we're not done yet. And despite all the noise you're hearing on social media from people screaming, "Bubble territory!" he's showing us pretty clearly that we're just not there. Not yet. But hold on, before I go any further with this, let me be totally upfront with you. I don't come from any kind of financial background at all. This isn't financial advice I'm giving you here, and please don't go making any buy or sell decisions based on what I'm talking about right now. Okay, so Raoul Pal, if you don't know this name yet, where have you been? This guy is absolutely one of the biggest voices in crypto right now, and those 1.2 million people following him on X, yeah, he's earned every single one of them. I've soaked up so much wisdom from this man over the years, it's crazy. Former Goldman Sachs executive, right? Plus, he's the brain behind Global Macro Investor and Real Vision. And he's been stacking XRP for roughly 5 years now. So yeah, he's got skin in the game just like we do. All right, let's dive into this thing. So what's popping up on your screen right now? That's the NASDAQ 100. Think of it as a collection of stocks, an index, and it's absolutely loaded with tech companies. This lives in the stock market world, just to make sure we're all crystal clear on that. When we're talking about the big name indexes that everyone watches, you've got your usual suspects. NASDAQ 100, Russell 2000, S&P 500. Each one gives us a different window into what's happening in the markets, which is exactly why tracking all of them matters. Now, the Russell 2000, that's your small cap playground. We're talking smaller companies, higher risk, higher potential reward. So when investors start dumping money into the Russell 2000, or maybe an ETF that mirrors it, keep in mind the index itself is just a benchmark, not something you buy directly, what they're basically telling us is, hey, we're feeling brave, we're ready to chase bigger gains. They're pushing further out on that risk spectrum. And this is where things get spicy for those of us in the crypto world. Because when that shift happens, when capital starts flooding into riskier plays like the Russell 2000, history shows us something pretty remarkable. We get an alt season. Not sometimes, every single time. This pattern emerges every few years, and when it does, altcoins go absolutely nuclear. That's precisely why we're tracking all of this. But wait, there's more. We're seeing these really tight correlations with the S&P 500 and the NASDAQ 100 too. And honestly, with the NASDAQ 100, the connection is absolutely undeniable. It shouldn't shock anyone, right? Because when you're thinking about crypto, you're naturally thinking about tech, and the NASDAQ 100 is basically a tech-dominated index. So what's pulled up on your screen here actually stretches back to the 1980s, believe it or not. And Raoul Pal had this really insightful take. He wrote, "No, it's not a bubble in tech stocks. We are less than one standard deviation from the trend. You can see what a bubble looks like in the late 1990s when we exploded out of the decade-long log regression channel to be multiple standard deviations from trend." And if you're actually studying the chart, it couldn't be more clear. You can watch the entire dot-com explosion unfold, followed by that devastating collapse afterwards. We're talking way, way above the trend, multiple standard deviations just blasting through the roof. And he's showing us exactly where we stand today. He's basically saying, look, folks, we're not even in the same ballpark. We haven't even hit one standard deviation above this trend line. He's driving home the point that this is absolutely not a bubble situation, which means we've got another strong indicator telling us we're not heading into bear territory. The cycle isn't wrapping up here. It's another data point you can reference. And he also wrote, but PE ratios are at bubble valuations narrative doesn't take into account the fact that during debasement, the P rises due to debasement more than E, which is anchored by GDP growth in general. If debasement is 11% and GDP is 2% trend over same period, then PE rises by 9%. ... Yeah, so this part totally clicks, doesn't it? It's straightforward stuff, nothing complicated about it. Then he comes out with this. This means that PE ratios double over 8 years or so. It's the denominator effect. Also, Bitcoin is less than 1 standard deviation from trend. It usually hits 2 standard deviations. This is driven by the ISM, which is the business cycle. That black line sitting right there on your screen in this chart, that's the ISM he's referencing. What he's basically telling us is that this whole dynamic gets powered by the ISM business cycle, which hasn't exactly been setting the world on fire lately. And when you look at the two together, the connection is pretty obvious. I've been touching on this periodically throughout my videos whenever I'm walking through current market conditions. And listen, there's no way I can unpack every layer of nuance in each upload. But this indicator right here, this is the one I keep circling back to. This exact measurement. And we've literally never experienced a crypto cycle top without seeing this thing spike hard first. So when you hear people throw around, this time is different, all right, maybe you want to make that argument. Perhaps we've moved past the 4-year pattern and we're looking at a 5-year rhythm instead. Sure, call it different if you want. But wait a second, is it actually? Because that timing detail isn't the critical factor we need to focus on here. Okay, so what's actually running this whole show? Global liquidity. That's the puppet master behind ISM data, behind the business cycle, behind all of it. Now, here's where it gets interesting. If we don't see this thing rocket to the moon during this cycle, then sure, we could say we're in uncharted territory. And whether that moonshot happens today, tomorrow, or lands in 2026 like Ralph Paul is predicting, honestly, the calendar date isn't the story here. The story is whether it happens or not. If it does happen, we're following the same playbook we've always followed. The only way we're writing a new chapter is if it just never materializes. But people keep tripping over themselves on this. They zero in on the timeline and say, wait, if his prediction stretches to 2026, doesn't that prove everything's changed? And I'm over here shaking my head like, no, you're watching the wrong game. You're tracking the wrong scoreboard. This isn't some everything's broken now moment just because the timeline got a little stretch marks. If we roll into 2026 before this plays out, there's an actual mechanism behind that delay. That's why I won't shut up about this part. So then he breaks it down, which in turn is driven by less need to add liquidity in the US due to most debts extending to 5 years and needing to be rolled over the next 12 months, okay? Walk through this with me. If we're extending debt maturities, going from 4-year cycles to 5-year cycles before refinancing hits, what's that doing to the liquidity timeline? It's kicking the can down the road. That's his whole argument crystallized in one sentence. This is the linchpin of everything he's saying. Let me hit it one more time. Which in turn is driven by less need to add liquidity in the US due to most debts extending to 5 years and needing to be rolled over in the next 12 months. $10 trillion, everyone. Can you see why his logic just lands with me? Time will tell if this holds up, but honestly, I find this theory pretty convincing. I know it's a minority opinion here, but I do find it compelling. $10 trillion. Okay, pause for a moment. What do you think goes down when all that debt hits the refinancing stage? Listen, do you grasp how much capital is going to be flowing everywhere? Can you visualize the ripple effect on the business cycle? Can you imagine what happens to investor sentiment when everyone starts chasing risk-on assets like stocks and crypto? Pretty straightforward, yeah? So whether this theory pans out or not, the underlying logic tracks, doesn't it? Really simple to grasp when you break it down. He continues by saying, thus the bulk of liquidity is delayed and forward-looking indicators suggest it lies ahead. Financial conditions give us a 3-month lead, and that in turn leads to ISM, which measures the business cycle, if you didn't know. That's what you're staring at on your screen at this moment. Look at this black line right here. Liquidity matches up perfectly with this movement. That's the whole reason I keep hammering this point home to you guys. This framework genuinely clicks with me. So if things unfold according to this roadmap, I mean, just skimming through price action and going, oh, everything's turning bearish, feels premature to me. You're really that convinced? What about these broader macro dynamics we're unpacking? Don't those carry weight in this equation? I absolutely think they do. This really gets me thinking, you know? And hey, if you've got a counter argument, seriously, I want to hear it. Lay it on me because I'm totally open to listening to anyone who believes this doesn't hold water. Here's the thing. I haven't found a convincing argument against this yet. And believe me, I've been searching for one. I actively hunt down thoughtful conversations on social media whenever I can. Because brilliant data-focused people like this, individuals with literally decades of hands-on experience, they're out there sharing their perspectives. And you know what? If I discover a strong case against this, I'm putting it up on the channel, no question. Because listen, I want to show you multiple sides of the story. I'm not about to dig into one viewpoint and then just keep pushing that same narrative over and over. I just want to land on whatever's actually true. And I'm betting you guys feel exactly the same way about that. Whatever's genuinely true, good, bad, or ugly, that's what I'm chasing because I want to live grounded in actual reality. That's my entire aim here. I want to grasp as many truthful things about life as I can possibly get my hands on. Full stop. I haven't encountered a convincing rebuttal to this particular theory so far, and then he throws out, and that all drive numbers go up. NASDAQ 100, NDX, has a slight premium currently, but that is normal at this phase. And honestly, he's nailed it with that one. Check out this pink line right here. That's the NASDAQ 100. And see this black line? That's liquidity. Now, yeah, the NASDAQ 100 is sitting above it right now. But here's the thing. Let's rewind to the last cycle. You know what? Exact same pattern. It looked great. Everything was cruising along until boom, it wasn't anymore. And look, go back one more cycle before that. I'm not making this up. Same exact story. The NASDAQ 100 had this nice lead, and then, well, you can see what happened. Go back another cycle, and guess what? Yep, same thing all over again. So here's what I'm getting at. This part we're seeing now, it's actually totally normal. If we're just dealing with a lengthening cycle that's tied to debt refinancing, which pushes global liquidity around, which then drives the whole business cycle, then all of this actually makes perfect sense. You see why I'm spending so much time breaking this down for you? Because honestly, most people just don't get this. This whole thesis, I mean, look, it's gotten pretty popular in crypto lately because Ralph Paul's been talking about it. But let me tell you, most crypto people have zero clue what any of this actually means. Like none. They're just staring at what looks like complete gibberish on a screen. That's exactly why I wanted to walk through this with you. Because if you're anything like me, and what you really care about is XRP absolutely rocketing and melting faces, then we need to make sure we're not heading into a bear market. We cannot be walking into another bubble situation here. We've got to blast way higher. And yeah, I'm hoping that's reality. But does it actually make logical sense to think that's what's coming? I'm still adamant, totally adamant. And there's a genuinely strong case supporting this. That's exactly why I'm filming this video for you right now. If you want XRP to absolutely tear through the roof and make you ridiculously wealthy, well, this is the exact kind of situation where if he's correct, this is what propels us there because we're looking at a monster alt season arriving way sooner than later if this actually pans out. And then he says, and Bitcoin usually decouples to the upside too at this point in the cycle. And check out this chart running back to 2013. You've got Bitcoin marked in pink and total liquidity in black, and just absorb that. Really take a good look at this. Look, here's what actually happens with Bitcoin. If you go back and check the last cycle, you'll see it does this coupling thing. I mean, yeah, it couples, but here's the thing. It's only for a really short window. It's not like it stays that way forever. People get this idea in their heads like, oh, it's decoupled. and then suddenly you stop seeing that strong correlation. But hold on, that's not what he's saying at all. What he's arguing is that it can decouple, and then boom, you can see that strong correlation pop back up again. That's exactly what this chart is showing us. Go back and look at the last market cycle. The same exact thing happened. Then check out the cycle before that one, and even the one before that. We're talking all the way back to 2013. It's literally the same pattern every single time. So right now, we're sitting at this exact phase right here. Fisher's gonna do what Fisher does. You know how it works with global flows and those big macro trends driving everything. And even though we haven't actually witnessed it happen yet, it just makes sense we're parked right at that sweet spot where it's about to pop off. That's his whole point right here. Okay, now check this out. This next chart, this matters way, way more than you might think. The NASDAQ 100, NDX for short. NASDAQ 100, which you call a bubble, has a correlation of 96% and Bitcoin 90% in terms of correlation. What we're seeing here is the DMI Total Liquidity Index. That's the magic number he's pointing to. That correlation is absolutely huge, people. Now look, I know the classic line, correlation doesn't equal causation, right? Sure, that's technically true, but here's where I'm going to push back. I genuinely think there's real causation happening behind this. You can call me out of my mind if you want. I've just got this little baby boo feeling about it, like a teeny tiny baby boo gut instinct hunch lunch munch thing going on. Raoul Pal doesn't stop there either. He goes on to say, which makes total global liquidity the most dominant macro factor maybe in the history of markets. This is driven by demographics, which drives debt. And guys, seriously, this is literally why I won't shut up about this stuff when we're breaking down what's actually moving markets on the macro side. Here's the deal. There's no one magic number out there. Nothing that just solves the puzzle completely. And listen, I'm not standing here telling you the business cycle is that answer or global M2 or whatever else people throw around, but I'm going to be real with you. This is probably the closest thing we've got. Like, this is really it. So when he drops this bomb saying total global liquidity might be the most powerful macro force maybe ever in market history, dude, yes, absolutely. And I see it too. That's literally why I've been shouting this from the rooftops for months. I keep coming back to it. There's no perfect metric that gives you the whole picture, but this is as good as it gets. And guess what? Raoul Pal is pretty much saying the same exact thing. Yeah, that's your main driver sitting right there. Absolutely 100%. And then he drops this line, and debt drives liquidity via debasement. But here's what people miss. This isn't only an American story. Go back to 2017 for a minute. The Fed was cranking up rates, running quantitative tightening, and Fed net liquidity was just sitting there flat. But then China and the UK jumped in and pushed total global liquidity higher, which meant stocks went up. Total global liquidity is the real game here. It's fiat debasement playing out in real time. But now here in the US, rates are just too damn high. Actually, let's pause on that. The rent is too damn high. You remember that meme guy? What even happened to him? The rent is too high. So Raoul Pal just dropped this line, but this time in the US, rates are too damned high, and that means we really need to allow liquidity to fill the void. And I'm sitting here like, yeah, tell me something I don't know. He's laying it out for us. That is why the cycle is lackluster thus far, because 2025 was not the year of the big debt rollover. Thank you, COVID, for allowing average maturity to be lengthened by a year as rates hit 0 cents. Classic. So the debt refinancing timeline got stretched out another year, and he's saying that's the whole reason behind what we're watching unfold. When did he first call this? I'm trying to remember, and I don't want to misquote the guy, but wasn't it something like a year ago? Somewhere around there. This dude spotted it ages ago, like way, way, way before anyone else. And look at us now, cruising toward the end of 2025, and suddenly everyone's waking up going, oh wait, we're pretty much out of room here, and this looks like it's bleeding into 2026. Not everyone's singing that tune yet, but a whole bunch of analysts are starting to nod along like, yep, this is definitely looking like a 2026 story now. Time will tell. Me personally, I don't play the prediction game with this stuff. Sure, I could if I felt like it, I just don't and generally won't. I'm more about bringing you the actual data. So you guys can make up your own minds about what resonates with you, but let me tell you, this analysis really grabs my attention. So yeah, he's calling out the pandemic and essentially arguing, hey, it's extending the typical maturity on these loans by around a year because rates collapsed to zero. Then he throws out this gem. So probabilistically speaking, things have shifted. And that's precisely why I've got the ISM chart pulled up for you here. He mentions, I am fully aware that this time is different is a powerfully dangerous symptom. But our view at GMI is that it is not different. It is the same, because the cycle is based on debt maturity. So pump the brakes for a second. Back near the start of this video, I dedicated some time, hold on, it actually took more than just some time to walk through, but I explored this entire framework of this time is different. I planted that seed deliberately because I could see exactly where he was heading with this. This time is not different. That's the claim everyone's tossing around. Hold on, what are you saying? It's not different, but it's shifted by a year. Well, that sounds different, doesn't it? Sure, on the surface that's different, but check this out. That's not the crucial part because that's not the underlying mechanism people reference when they claim this time is different. Okay, so something really fundamental has to be moving here. And look, I don't want to twist what Raoul Pal's actually saying, but here's what's jumping out at me. This time factor everybody keeps pointing to, that's not where the magic happens. Because time's just going to tick by however it ticks, based on what's genuinely driving everything below the surface. Global liquidity flowing in and out, business cycles doing their natural dance, debt getting worked through and refinanced. That's why I broke it down like that a second ago, and that's literally the case he's building in this moment. This time is not different. Even if the cycle stretches to 5 years now, what's that actually mean? The real machinery pushing markets around hasn't transformed at all. That's his position here. Look at it and you'll catch what I'm saying. Then he pivots and tells us he's still cashing out lifestyle chips when things rip toward fresh highs, while ETH, Solana, SUI, those become his insurance policy against calling this wrong. So look, I'm not the type to just sit around during market cycles twiddling my thumbs. When prices dip to my sweet spots, you better believe I'm jumping in and stacking more. That's how I roll. Now here's where it gets interesting. This analyst comes full circle and basically drops the mic with the same message he started with. Folks, we are not in bubble territory. This is something completely different. The juicy part is still coming. So here's my take. If this guy nailed his analysis, and I think he might have, XRP holders are about to eat really well. And honestly, your altcoins in general, they could go absolutely bonkers from where we're sitting right now. I'm talking levels that'll make your head spin, because we haven't even hit the good part yet. Why on earth would you be freaking out right now? Makes zero sense. Leave the fear at the door. Oh, and before I forget, massive disclaimer here. I am not a financial advisor. Please, for the love of everything, do not make buying or selling decisions based on some random person on the internet. That includes me. Seriously, that's a recipe for disaster. All right, I'll see you guys in the next video.